All right, folks, and good morning, and welcome to the Short Vol Show. My name is Dave, and as we end the week, you can notice that not a whole lot has happened in UVXY, and we got a little bit of a rally, a little pop in the VIX, and but in real terms, UVXY really has not had much of a range. If I was to just kind of guess in my head what the range was this week, I would say it was between like 920 and 970 maybe, so like 50 cents of a range. And people might say it's hard to make money in something that has a 50-cent range per week. To which, let's try this again. Oh, it got all the way up to 10. It did get up to 10 in the after hours yesterday, I suppose. But let's just talk about during the day. Or you can even use that. Let's use the 10 even. Either way. It has had a range. Yeah, so it got down to, it looks like 910 or something at the lowest. Yeah, 905. So it's had a range between 905 and 10. So let's just say a dollar range, just to be charitable. And a lot of people would say, gee, Dave, how are you going to make money on something that only has a dollar range per week? And people might say even, how can you have a show on short vol when there's just not enough going on to even to justify that? To which I say, as an options trader, the range of a stock is having something that doesn't move at all can be just as profitable as having something that moves all over the place. It's just it's up to you to call what's going to happen sort of ahead of time a little bit. And as a short premium trader, I love stuff that doesn't move at all. And I outlined a strategy to make money in this on the slow creep down last week, and I just wanted to go over it again with you because it would have been working for you if you'd put it on last week, and it's a perfect strategy for this slow creep down once again. And so we'll go through that in a sec. In the meantime, let's back up a little bit and let's take a look at sort of the week in review a little bit. Here in my world of the U.S., the big thing which is still going on is the whole the politics, the U.S. politics, and the fallout from the Trump-Helsinki visit. And it appears that I was kind of I found the news conference to be sort of shocking in many ways, but it appears that the backers of Trump in the Republican Party is not going to sort of react to this visit in a shocked way. They're just going to kind of move forward. The newest announcement is that maybe Putin is going to come to the United States or has been invited to come to the United States. Another announcement that's come out sort of is that Republican leader is calling to continue funding Obamacare at this point. The speculation is that this is because a lot of the midterm election, like TV commercials being run by the Democrats, are saying that the Republicans basically are responsible for healthcare premiums going up because of their actions to defund Obamacare. Now, what were the actions to defund Obamacare? Because we know that they were not able to pass anything in the Senate to end Obamacare. But what was passed is the requirement to pay a penalty if you don't have insurance. So, for example, for the last few years, if you're in the United States and you did not, if you did not pay for a minimum level of health insurance, you were penalized and you had to pay a fine. And that money from that fine was going towards helping to finance Obamacare as part of the way to fund things. And that is going to be ending soon. And so it basically is thought to destabilize the system, because that money that they were counting on from people who had opted out of the system will no longer be coming in. Another thing that has happened is that the money, some of the monies that the government was paying towards Obamacare, towards the insurance companies, are no longer coming in. There were these setups where they kind of evened out the playing field between insurance companies, where if an insurance company had a lot of sick people, the other insurance companies that had less sick people were making payments to them to sort of even things out, so that across the board, insurance companies had an equal responsibility for the sick people. Insurance is a thing where everybody pays in a little bit, and then a few people get the benefits of that, and that's just the way it works. We all pay in, and then it's like, let's take car insurance, for example. We all pay in, and then if a person gets in an accident, that money goes to fixing the car from that one person's accident. And some people don't like that concept. They think, well, why should I pay for, I should only pay if I'm actually why should I pay for someone else's accident? It's their fault if they had an accident, or if their fault if they got sick. But that's just sort of the nature of insurance. And it's a balancing act, because when you include people with pre-existing conditions, when any things that you do to include more and more sick people, everybody's going to have to pay a little bit more. However, you are including in the protection more and more people that way. So it's like, once again, a balancing act. How much do you want to include more people? And from my point of view, the health insurance industry in the United States is, people like to say, oh, well, why don't they just do it like Europe? But the thing is, at this point, all the companies in the U.S., they're already set up in the structure, and they're already making a lot of money off the system the way it is. So if you were to change it to try to make it more like, say, the European system, those companies would lose out on all their profitability. And so they're very powerful, and they fight it tooth and nail. And so if you think about it, everything's so expensive in the U.S., well, where's all that money going to? Well, it's going to all these companies, and they don't want to give up those income streams, and so they fight it tooth and nail. So it's not as easy as saying, well, let's just switch over to a different system, because the companies represent the people in power, and they're not giving up that money that they're getting. Anyway, so back to main news. Let's take a look quickly at Drudge Report here. And Musk meltdown fear. So I don't necessarily like to see this, considering that my main position is short options in Tesla. So, but the market is not reflecting this headline at all. Tesla seems very calm today. Well, actually, it's given up a little bit in the last few minutes, but still relatively calm today. Let's see what this article has to say. Musk meltdown fear. Elon Musk's bizarre tweets are raising red flags on Wall Street. And it's just relating back to his tweets about the divers. On one hand, I say, somebody like Elon Musk doesn't need other people to defend him. I mean, he's already a very smart person and got all the money in the world. And on the other hand, the stock prices speak for themselves. The stock doesn't seem to be spooked, so I'm not going to be too worried about that news story. All right, so let's get back to UVXY here. So what do I mean when I say that having something not move around a lot can be very profitable as it is? Well, options trading allows you to do a lot more than just being long or short something. It allows you to say how much something's going to move, when it's going to move there, and when something's going to move in a certain place, how quickly it's going to move there, and how long it's going to stay there. You can set up an options position for anything. And the option position that I was talking about last week was to put a sort of calendar spread on in UVXY centered around the strike that you think UVXY is going to go to. So if you're going to be short an option, you would like the underlying to go to that spot and stay there. Well, if you're short an option, ultimately what you want is that option to go out worthless, right? So if I'm short the 9 put, no matter what, I want UVXY to end above 9. But a calendar spread is not just short one put. It's short one put and long another. And so the fact that it's short one put, long another turns it more into sort of a straddle situation, meaning that if you are trading a calendar spread, it acts like being short a straddle. So that would mean that you would want the underlying to go as close to that short strike as possible and stay there right up till expiration of that short strike. Conversely, because a calendar spread is a long vega position, you would like volatility to expand. So if nothing's going on, you'd like it to just go to that strike and sit there. If stuff is going on, you would like volatility. You would like something sort of violent, so that volatility pops and you make money on your long vega. But the strategy I was outlining the last couple weeks was to put calendar spreads on in UVXY centered along where you think it's going to go to, which we've ascertained is slowly lower. So I had calendar spreads on centered at the 12 strike, and then I had calendar spreads centered on the a little bit at the 11 and 10 and 9 strikes. And indeed, having a calendar spread centered at the 9 strike would have worked out because we were coming down from 11, 10, 9. So what's an example? So let's do an example of a calendar spread centered at the 9 strike here. And let me just take a look and make sure that let me get out of the way here. All right. So if we pull up UVXY, let's take the Ds. So we'll buy some Ds 9 puts. So what I'm doing is I'm going into Thinkorswim here, and I'm clicking on the offer of the December 9 puts here. And it's bringing up my order entry screen. So it's saying buy Ds 9 puts. And what I'll do is I'll widen this out here. So it's showing me buy 1 Ds 9 put, 273. So then I'm clicking to close the order entry tool, and I'm going back up to one of the puts that I want to sell against that, and maybe we could pick something like August 14. I'm sorry, August, 3 August puts, which have 14 days till expiration. And I could go to the August 9 puts and click on the bid. I'm going to hold down Control and click on the bid, and that's going to add that trade to the first trade. So now we've got buying Ds 9 puts, selling August 9 puts. And it's going to give you the price here. So essentially, this trade, what we'd like to happen is this trade to become more valuable over time. And the way it's going to become more valuable is for the December 9 put to decay faster, the one we're short, I'm sorry, the August 9 put that we're short to decay faster than the put that we're long, the December 9 one. So we'd like this price to go from like $2.20 to like $3, maybe something like that. So if I go to the right side of this trade and I right click on my mouse, I can select Analyze Trade, and that's going to bring us into this Analyze window. Now, what I like to do to make this more obvious is I'm going to change the number from 1 spread to like 20 spreads, just so we can kind of see what's happening more here. And there we go. And I don't 100% know why this shows P&L on the day of -300. It should be flat. So when we look at this, we're just going to have to look at it at the change in P&L, because this should be flat to start with. Because if we just put the trade on right now in the middle of the market, we wouldn't be losing money. So not quite sure why that says that. But if we were to move this forward a couple days, you're going to see that each day, according to this, you're collecting a certain amount of theta. We started out on the 19th, or sorry, we started on the 20th, and we were collecting $25 a day in theta. So that means if things just stay here, every day we're collecting 25 bucks on this trade, which means we're making money when it's not moving, which is great. So if we want to sort of analyze this trade, we can kind of move the dates forward a little bit. So as I move the date forward, notice how the delta is getting more and more negative. When we know theoretically that as we get to expiration, the best place for this to go, the best place for us to be is actually at 9, if this goes directly to 9 and stays there. So that means that as we get to expiration, the delta is going to be shorter here, because remember, this is going to turn into either 100 deltas one way or the other, above or below the strike, once we finally get to that strike on expiration. So anyway, so if you can see, as I click the days, as days go by, it simulates that theta being added to our P&L every day. And you can see that if this just sits here, we will collect money every day. So this can be a great position to have on if we just slowly creep down to 9. If I change this price down here to 9 and move the date forward, we're going to see that I guess I have to lock this. We're going to see that it makes the most money at 9. What's the risk on this kind of trade? Well, the risk is that either we move way away from the 9 strike, and there's not time to get back there. So that's going to make you lose money. If this thing rips to the upside, you're going to lose a little bit of money. And I have the example here. If it goes to 17, you're going to lose a lot of money. But the way to counter that is to make sure that this short strike you have is not too close to expiration. The closer this is to expiration, the more dollars you're going to collect per day. But if it's like 1 day away from expiration and we spike, you're not going to have time for it to come back to the strike. So it's a trade-off. So let's say I move this to the front week. Let's see. Let me reset our date here, and we move this to the front week, the short side of this trade. Well, then we're collecting $120 a day. We're collecting a lot more per day, but if we spike or something, it's very risky for this that we don't have time for it to come back. If I move it out a week, collecting a lot less, but we've got time if we spike for this to come back towards 9. I like to keep it reasonable, I don't know, between a week and a month probably for the short side. You can kind of experiment. You can either go into your analytics here and experiment with how long out you'd like to make this. If once again, if the long side of the trade, if you're to move the long side out, that's also going to affect your decay. the thing is that the more you move the long side out, the more the trade is going to cost to put on, because that longer dated option is going to cost more to buy, and so that's going to change your return on investment to some extent. You know, if I took this out to Jan of 2020, well, all of a sudden you've got to pay twice as much to put this trade on. So any profitability would only reflect, you know, half as much profitability per the amount of capital you're putting forward. So it's a trade-off. You're going to have to find your own sweet spot with this sort of trade, but let's just go through once again my thought process here. So starting out with saying, okay, UVXY, in my opinion, is going to creep down slowly towards 9 in the next month. And, you know, I can be, you know, pretty right and still make money on this. If it rips to 5 tomorrow, then I'm going to lose money on this trade, but that's highly unlikely. But if it slowly creeps down towards 9 over the next couple weeks, then it works out pretty well. My thought on this right now is that UVXY is going to go through 9 and creep down towards 8 in the next month. But when you look at the premiums on stuff, it's harder to find any meat in the 8 puts. I mean, there is something, but like 7 days out on the 8 puts, you know, they're worth a penny. So you don't want to buy an 8 in December or January and sell something for a penny against it. You'd rather just hold on to it than give away. You never want to give away a unit in options for like 5 cents. You'd rather hold on to that unit for some other time when you could sell it at a higher price. Like here, 2 weeks out for the 8 puts, excuse me, 2 weeks out for the 8 puts, they're only worth, the bid's only 6 cents. Once again, I don't really want to sell something for 6 cents because the most I can make in the optimal situation on that option is 6 cents. So 21 days out, 15 cents. Okay, it's getting a little bit better, but 15 cents over 21 days, that's less than a penny a day you're making on that option. Ultimately, you know, in the optimum conditions. So still doesn't sound great. So this is sort of why I'm sticking to the 9 strike here, even though decay and our assumptions on contango and decay and whatnot might make this go slightly lower than 9. I'd rather stick with that. And remember, if it does go through the 9 strike, you can still make money on this trade, and you could actually adjust your deltas where maybe you buy a couple extra of the I have it set to Jan here, but maybe the D's puts, you might maybe in the end you buy 25 D's puts and you only sell 20 of the Julys against them, and you wait to sell those other 5 puts till things get lower to lock in a little bit more profitability. You can kind of massage the trade that way. Ultimately, I end up looking at my Greeks here and seeing how long or short the Greeks make me. So I would recommend just trying out some of these trades and get out there in your analysis trade and tab and see what it looks like, and try out some stuff and see what you get. And then once you've tried it out in analysis, maybe put some of these trades on small. Maybe just put 1 lots on and see how it works for you. You're not risking a lot of money, but it's going to help you start to understand how options work and how things move through the cycle. So give it a try, get out there, try a couple little trades, and you can slowly start to work your way up. It's actually a lot of fun, and I mean, starting to trade options opens up a whole world for you, because you don't need to have a big move to make money. You can make money on a big move, and you can set yourself up to make money on a big move, but you can also profit in markets that are kind of like a little bit slower, like right now in UVXY. You know, it's an exciting thing being in 5% contango, because that means we have real decay. But watching this stuff day to day can be less than exciting because it moves relatively slow compared with some other underlyings. But the point here is to make money, not to have excitement. And this is one way you can do it, is by being short some of this stuff as it slowly moves down towards strike. Anyways, thanks for watching today, and I have some exciting stuff coming up, and I am getting to work on editing my interviews so that I can put them up here for you very shortly. Thank you for watching, and I'm going to put our latest contributor, Ruth Ann Mendoza, on to take us out here. And just 1 second, here we go.
I know your eyes till the morning sun. I feel you touch me in the pouring rain.